Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. And hello, everyone, and welcome to the Greater Central Florida Multifamily Investor Show, where we focus on investing where it makes sense. I'm your host, Ismael Reyes. Somebody said I needed to say El Rey.
El Rey. Oh,
we're gonna go with El Rey on this one. And so, it's great. This show is all about folks that want to invest in multifamily, whether it's investing with partners that are in multifamily here, or whether it's just investing with partners elsewhere, and the partners just happen to be both here in Florida. So really looking forward to kicking that off. And what's important about tonight, and I've been wanting to do this show for a while, and Douglas and I have been chatting on this because what is essential to me, and I've been in a situation probably weekly, really. I get a call from somebody, and let's just say a lot of times, and my last one was a Master Sergeant Garcia that called me, and he wanted to invest in multifamily. He's very excited. He called me. He saw me on, I believe he said LinkedIn is where he, and I do put out information on LinkedIn there when we have acquisitions that are available for investment. And so he reached out. He said, "I'm ready to do this." He had a spouse on the phone, and he was really looking forward to it. And when we started talking about it, it was the requirements. This was a 506C, a Regulation D, 506C syndication. And when we started talking about it, it became very obvious that he was not going to qualify, unfortunately, for that. And so you could kind of hear the kind of, if you think of the like a balloon, and it was just, the air was just kind of let off slowly. It's like, oh, well, how do I do this? And and so I tried to explain to them there's some ways. We have a 506B, a Regulation D 506B, which allows us to bring on sophisticated or non-accredited investors up to $35 deal, right? So 35. But in order for us to really go after sizable assets and really take advantage of the scale aspect of multifamily, which is what a lot of people like, you really can't bring in people for too little of an investment. You got to get up there. And so we're normally looking at, anywhere from 50 on average, 50,000 a minimum investment. Sometimes we can go a little bit lower. A lot of times we go higher. And so not only was he not accredited, and for those that don't know, accredited means, if you're a couple, you have to have 300 of income, $300,000 of income for 2 years, 2 consecutive years, or net worth of $1 million, not including your personal residence. And so that didn't go. And then in his case, he's like, well, when's your next sophisticated deal? I want to get on it, And then I said, well, we don't have one. We're going to have one soon. But again, I recommend that you do bring on another partner, a joint venture or something, so you can get your amount a little bit higher to get on. And I could just see completely just deflated. And so what I like about today's show is that we're going to turn that around. We're going to turn it around because what regulation crowdfunding, and I won't give it up anymore, allows us to do is to bring in as many non-accredited investors on an investment as they want to come in. And for as little as, I want to say, and I don't want to throw out the exact number, but I think a little over $2,000 is the minimum that people can use to get in, which is obviously much more palatable for a lot of people. And it's going to give a lot of people a chance to get in on these. So I'm not going to say any more. I do want to do an initial welcome of our guest. Douglas, how are you, man?
I'm doing fantastic. How are you? And thank you for having me on.
Oh, my pleasure, man. All right, here we go. Douglas Ruark is a principal founder and president of Regulation D Resources, or RDR. RDR was formed in 1999 for the purpose of providing Regulation D exempt offering advisory services to corporate clients. Regulation D Resources provides a securities offering preparation services for Reg CF or crowdfunding, Reg D, and Reg A plus offerings, financial structuring and evaluation guidance, and has in-house industry-leading software solutions for management of private placement investment compliance processes. Regulation D Resources has provided advisory services for over 5,500 Regulation D exempt securities offerings since 1999. That's a lot. And has a core focus on real estate, energy, and technology syndications. RDR is considered one of the nation's leading firms in this specialized field of corporate finance. Regulation D Resources services Fortune 500 level clients, in addition to, and I like this, smaller startup and development stage companies. So they've seen it and done it all. And then Douglas personally has core competencies in SEC securities regulations, real estate and equity fund syndication, corporate valuation, risk analysis, and offering document presentation or preparation. So that's a lot. So really, you're the right person for this, Douglas. So I'm going to stop talking. I'm going to turn it over to you, Douglas. The floor is yours.
All right. Well, first of all, thank you for putting me on the podcast. It is an exciting topic. And I think ultimately there's so much that's changed in the last 10 years, but also even in the last year that is very impactful for real estate operators that are looking to raise capital for syndications or if they want to do a multi-asset fund. First, a little bit about me. I'm president of Regulation D Resources. We're a 23-year-old firm. We essentially have two sides to our business. We do general offering preparation and SEC filing work, and we do cover Regulation D, Regulation CF, and Regulation A+ securities offerings. And then we also have a technology side where in-house we can build and deploy investor Reyes portals, essentially Reyes portals that will engage your investor prospects for the securities offering and take and track them through all the investment processes. So ultimately in-house, we're able to put together a securities offering for the client, get all the filing work done with the SEC, but also bring the technology component into play to allow them to execute a raise in an efficient manner. As far as in general, when you look at syndicating capital for real estate, you are going to have security sales that happen. So if you're looking at, say, a typical syndication for a real estate asset, you're probably going to have a limited liability company in place. And if you're raising equity, you're probably selling membership interest to the investors. So I think it's important to understand that pretty much any raise where you're bringing capital from outside investors is going to trigger a security sale. And then ultimately what you have is three primary options in order to execute that raise properly. And, it's Regulation D, Regulation CF, and Reg A+ are really the three options. Now, Ray mentioned, Reg D 506C. That has been a popular option, mainly because it was one of the exemptions that got created under the Jobs Act of 2012. It does allow you to generally solicit to the public, but it is limited to accredited investors. So you're limited to this small slice of the investing public that can come in and invest, which is, obviously what Ray dealt with there. So what's really changed, and obviously kind of the focus of this podcast is Reg CF. And we're really seeing a lot more real estate operators now using Reg CF. And I think part of it is because of the changes that happened March of 2021. And there were two impactful changes to Reg CF. Because understand, Reg CF is crowdfunding. I would say get that term out of your head. At this point, the way these new Reg CFs execute, it's just another way to raise money. It's just another program to execute under. But ultimately, there were two changes that happened in March of 2021. The first was the SEC took the old Reg CF limit of $1,070,000 and they raised it to $5 million, which was huge. We normally didn't see a lot of real estate operators wanting to come in and do any CF work at the lower level. Now with $5 million, that's a decent amount of equity. And a lot, obviously a lot of these syndicators are using that paired up with debt in the capital stack. So a $5 million in equity could leverage you 25, 30, maybe even a $35 million purchase. So that was really change number one. The second change was that the SEC decided to allow FINRA broker dealers to serve as the intermediaries on these offerings. So understand with Reg CF, you have to execute that either on a CF platform, like a Start Engine or a Republic, or now you can execute with a FINRA broker dealer that is your intermediary. And the big advantage to that is severalfold. Number one, you get your own Reyes website now. And so when we do these CFs now, they execute with your own Reyes portal, running on a domain of your choice. It is hosted and managed by the broker dealer through the term of the offering, but it's your Reyes website. So you're not sending someone to a Start Engine where there's 400 other deals. You're not paying 8% commissions on the money. You're not losing control of your data. That's something else that a lot of people don't understand with the CF platforms, is you're going to funnel all that prospect traffic in. That's not your data. So that was a very impactful change, because what it actually allows now is for you to do a Reg CF offering that mimics a Reg A plus. And that third option, Reg A plus, really is the kind of the most sophisticated offering you could do as a syndicator. Usually we're seeing Reg A plus for larger offerings where someone wants to go raise 50 or $60 million for a real estate fund. We do have some that are smaller, obviously. But the benefit of Reg A is you can generally solicit the public and you can raise money from everyone. Well, you could do that with a Reg CF. And so I think then what's really happened is with those changes, it's opened the door to allow you to do what amounts to a mini Reg A plus without having to go through that process, because Reg A is a different process. You got to basically put together what amounts to an S1 filing and get it qualified through the SEC. So Reg CF now opens the door to anyone being able to invest. So when you put that CF together and you launch it, you can go out on your LinkedIn, your Facebook, your corporate websites, and you can generally solicit the public, but everybody can invest. And so that's one of the big advantages, is that you now have the ability to really crowdsource this capital for your syndications, and you don't have to exclude anybody. Now, some of the other advantages of Reg CF, you get a 3-minute investment process that runs right on the website. We have a technology partner that we use for these Reg CFs. It's a company called CoreConnex. They are a transfer agent. They're also a technology provider, meaning they bring these back-end systems and rails to get people through the subscription process in a very efficient manner. And it is 3 minutes. And so I literally go to the Reyes website. I'm interested in investing in this deal. I read the Form C and circular. I learn about the deal. I decide I want to invest. I hit the invest button. I provide some basic information on myself. I type my name in and hit submit to execute the subscription document. And then I pick my payment rails. Oh man, I've been waiting to invest with Ray. I'm gonna go ahead and put $5,000 on my Visa here real quick and invest in his new multifamily syndication. It's that simple. And so we're really now seeing a tremendous number of real estate operators that are bypassing going Reg D 506C because they want to raise money from everyone. And now they have an option to do that without having to step up to a Reg A plus type vehicle that is 50, 60 grand to put in place, and 4 to 5 months to get it qualified and out on market. So with the CF, you're at 15 grand when you factor in technology partner fees and escrow and then our fees, and you're at about maybe 60 days, 45 to 60 days to put something like that in place. And that's that's being fairly conservative on timing. So ultimately these changes, they've been very impactful. And I think we're going to see now a lot more real estate operators using it. And I'm even seeing guys using it for multifamily real estate funds, where ideally they are probably going to grow that fund to be a very large fund, but they just want to start off with enough equity capital to leverage an acquisition or two to get their portfolio going. And so they'll do a Reg CF as their kind of first round. They'll get some equity capital in, they get those first acquisitions in place, and then they could do another CF round where they may step up and do something like a Reg A plus if they need to raise larger amounts of capital. So with these programs now, I think there's a lot of options. Look, you may still have clients. I may still have clients that do a Reg D, but normally now on these Reg Ds, it's probably going to be pre-syndicated capital, where a Ray shows up at my doorstep and says, "Hey, Doug, I got 2 family offices that want to invest with me, or I got just a bunch of high net worth people that want to invest." All right, fine. You can still do a Reg D. It's still an option. But I think for people that are looking to get into the public domain, raise money, be able to generally solicit, and bring in capital from everyone, Reg CF is going to be fantastic. And, as long as they can keep it in that 5 million or less box, they're going to be able to execute with a very effective securities offering. The other vendors involved in these CFs, you would have a broker dealer, you would have the transfer agent, you also have an escrow account. And so when you execute I think part of the advantage of CF is that you're getting a very sophisticated offering that has a broker dealer on board. So you could sell in all 50 states under the license of that broker dealer. That makes investors feel more comfortable. They know there's a FINRA broker dealer on board with your offering. They will typically take about a 3% commission on funds raised. The transfer agent's job is there to record who owns securities in the company. So if you end up with 200 investors in a syndication, it's the transfer agent recording who owns securities, what type of securities they own, how many they own, when did they purchase. And then the escrow account is simply there as an intermediate stopping point for the capital, if you want to think of it that way. It's coming in, it's initially hitting the escrow account. That gives the broker dealer time to do their know your client and anti-money laundering checks. And then from there, normally on the real estate deals, you're going to have a minimum offering amount. So it might be, hey, we need 3 million ideally for this syndication. We can still get the deal done with 2 million. So 2 million is the minimum offering amount. And that's the amount that you'll raise up to clear that. And then at that point, you can start utilizing funds. So a lot of changes. I think part of it is we're at this really exciting point now where you have the technology. You have technology like Core Connect brings with this 3-minute investment process running right on the website. And then you also have a back-end solution to manage these investors once they're in your deal. You have the ability to, with a couple mouse clicks, get a ton of exposure for your deal. I mean, if you go out on a LinkedIn or you have an affinity group you've built, you're a couple clicks away from getting your investment opportunity out to all those people. And again, now they can all invest. And then number 3 is just the rule changes, the ability for a company to execute what amounts to a public offering with what is essentially 45 days of some filing work and putting some technology together on a Reyes website is pretty amazing.
So Doug, quick question for you while other folks also get primed, and we'll probably go into some other areas here, but let's talk about what I foresee happening to some of us, right? We've broadened out our networks, and we have multiple operators that we work with on these acquisitions. Usually it's not one entity alone that runs these things. So let's just say somebody finds a great deal and they need $2 million to close that deal out. They already have a 506C on there, the normal typical syndication for accredited investors only, but they need 2 million. Can I use a fund that I create to basically plug in that 2 million that they have left and complete that? Almost like if it were, for example, a 1031 exchange where you're doing a tenant in common, where you have your syndication and then you plug in that tenant in common so you can use that 1031 funding. Is there such an animal for these type, for the Reg CF?
Yeah, so a couple things related to that, because that actually brings up 2 points. So first of all, technically you could run a Reg D 506C and a Reg CF at the same time. We don't see it all the time because really at the end of the day, since the CF can accommodate everybody, just go ahead and do a CF. Where we might see the Reg D being involved as kind of like a sidecar offering from that issuer would be if the client needed to raise, if they have maybe some institutional capital they wanted to bring in and they just wanted to bring them in through a separate vehicle. I think the other thing to keep in mind is that you cannot be an investment company and use Reg CF. And now we're stepping into, what is an investment company? Well, an investment company is a company that would raise capital into a pooled vehicle for the purpose of purchasing the securities of other companies. So where you would want to be careful is if Ray creates an entity to raise money and Doug has a syndication with an offering, and I say, hey, take some of your money from your fund and come buy securities in my deal, that's where you'd have to be careful, because now you're talking investment company act activity, and that is precluded under programs like Reg CF and Reg A Plus for the most part. So ultimately what you'd really see is that, that issuer or the syndicator just doing a direct CF out of the gate. 1031 exchange money, it is important to understand that with 1031 exchange money, if I'm the investor and I've got the 1031 exchange money, I can't just buy membership interests in somebody else's syndication and have that, be a qualified investment. So essentially, they're going to have to be tenant in common on the property. They're basically going to be a separate party into the purchase agreement itself, alongside the syndicator and the investors they've pulled into their vehicle.
So theoretically speaking, then the Reg CF couldn't be that separate entity in a deal that has a 506C, or because they're so closely affiliated, it wouldn't work that way?
Well, ideally, the CF is going to be done by the company that's actually going to be acquiring the asset. So ultimately, that's what you're going to see, is you're going to see that the syndicator that's actually raising the money, that entity that's doing the offering is also going to be purchasing and owning the asset.
Okay. And so in a hybrid where you have a 506C and a Reg CF that are run simultaneously, because you're running them simultaneously, it does allow that to be the case, as opposed to completely separate 506 syndication where you're trying to bring in funds into somebody else's deal, even if they offer you a portion of, let's say, of the general partnership.
Well, yeah, I mean, ultimately, like I said, there really isn't going to be a need for a syndicator to do both. I mean, technically, the SEC did create the carve out that allows both to be run simultaneously, but you now have two separate securities offerings, and they have to be treated as separate securities offerings. It does create some complexities too, because now you have cross disclosures that have to happen. You have the same issuer entity raising money out of two separate securities offerings with different sets of rules. The other thing you'd have to clear it with is the broker dealer, because understand, with the Reg CF, the broker dealer is really the one calling the shots, because it's their license on the line. So their compliance department would have to sign off on that type of structure. Ultimately, I think for the average syndicator, if they're looking to just pool money for an acquisition, they're just, the entity they're raising money into is going to do a CF, and that, that obviously then just accommodates everybody.
Okay, got it.
I have a quick question, Doug. So will an investor that invests with a CF save any taxes, or does he get any tax incentives at all?
Well, that's a good question. They're not going to really have tax incentives per se. I mean, the only time you'd really have like a tax advantage structure is if you did a true REIT. We actually don't do a lot of true REIT structures. I mean, a REIT structure, you're going to have things like 90% of your income from the portfolio has to be delivered to the investors. So ultimately, what you're looking at here is this is just a means to onboard the capital from various investors and do it in a compliant manner, but they're not going to necessarily have a tax benefit vis-a-vis the investment. Typically, what's going to happen is they're going to share in really two income streams. They're going to share in any income stream from the property itself. So the property gets acquired. It's an LLC, for example. There'll be a Class A membership interest typically for the investors. There'll be a Class B membership interest in that entity for the sponsor. And then from there, there'll be a waterfall that delineates the distribution. So if there's, X amount of lease income, it's going to get distributed on a 70-30 basis between the investors and the sponsor. And then obviously the second revenue generating event, hopefully for the investors, is potentially a sale of the asset, where the asset gets sold and there's obviously profit from that, hopefully. And then essentially then they'll trigger a secondary waterfall in the deal where, initially capital gets returned to the investors, and then there'll be a split of that profit from the sale event between the sponsor and the investors.
Okay, thanks. And can that investor, when at the sale from the profits, 1031?
No, because they're really, what they have is they have a security. They're holding a security. So that's different than them actually owning the property itself, tenant in common.
Thank you.
What does the investor get, Doug, at the end of the year at a sale? Do they get a K1? What is it that they normally get for tax purposes? I mean, even if there's not a huge advantage, my understanding was that some of the depreciation does carry through.
Yeah, so I mean, normally when you're in these deals, and mind you too, you can use a Reg CF to raise debt. So I should mention that almost all of our real estate deals are equity, mainly because the syndicator is either looking to do an all equity deal, and we do have some of those where they just don't want any debt in the capital stack, or they're going to more often than not use that equity to leverage institutional debt. So leverage a perm loan or a construction perm loan, for example. Typically then, if it's an equity-based deal, then if those investors are members in the LLC, yes, they are going to be getting a K1 representing their share of any distributed income from the operations of the company.
Okay.
So, and then I think too, when you look at how these are being used, there's a couple different ways that these are being used. So the first is multi-asset fund. So you form an LLC. The goal is to purchase between 1 and 6, multifamily properties. And then ultimately you're going to do a raise that is going to accommodate between 1 and 6 properties. And so, now you've got an offering that can accommodate the purchase of multiple assets. For the investors, the benefit there is they're going to have a pool of assets that they're obviously sharing in rather than one asset. The second way we see these structured is a single asset deal with an identified asset. That asset usually then would be under control. So the sponsor probably has put it under contract. That contract's assignable over to the entity that's actually raising the money. And the only challenge with those is timing. Obviously a seller's usually not going to want to sit still for a long period of time. And so ultimately, you've got to put an offering in place and go syndicate capital in a fairly short period of time. Third way we see it is what I call blind acquisition. That's kind of an industry term when you do like a blind pool fund. But the reality is the investors know what you're purchasing. The way this structure works is I basically set an offering up, and the offering is that I'm going to go purchase between a property located in Florida between 30 and 40 units. That's going to be Class B or Class C property, and that the strategy is to rehabilitate that property, lease it, season it, and sell it. The benefit here is that there are no properties under contract, so you're not under the time frame pressure. So you can put the offering in place. You've specified to the investors essentially the gating around how you're going to use the capital. You raise the capital, and obviously as you're raising the capital, you're going to have your wish list. You're vetting properties. You're obviously going to have a list there of properties that meet your criteria. And then as you clear the minimum offering amount, that amount needed to then take a property down, you're at the point now where you can put a contract in on one of the target properties that you've already vetted. The benefit with this strategy is that you're not putting a property under contract and then having time frame issues to go out and syndicate capital. You're able to kind of put the offering in place, syndicate capital, and then you could be opportunistic at purchasing the asset. And obviously the only thing here is that asset just has to match the parameters that we built into the offering as far as what type of asset's going to be going into the entity.
I have a question. That's fantastic information, by the way. You may have mentioned this already, but in a CF deal, can you apply cost appreciation? Is that spread across all of the investors?
Cost appreciation. Are you talking about the?
I'm sorry, cost segregation, the depreciation from cost segregation studies.
That I'm not a CPA, so that would probably be a better. That's more of a tax and accounting question. I mean,
okay.
Essentially, what does happen is typically any kind of depreciation or losses can be spread out over the membership. And from there, it really just depends on what the operating agreement has been structured to do as far as handling those types of events.
Gotcha. And my second question, thank you, is would there be any reason whatsoever that a family office or a large scale investor would not want to participate in this type of deal?
No, I mean, I think ultimately if you do have a family office, it depends on really when they've come in. I mean, if you've got a $3 million CF and you've already raised $1 million and you've got a family office that comes in, I think it just depends on whether or not, how much money are they investing? And then, do they want special terms? That'd be the only kind of X factor there is, is trying to accommodate that. Because ultimately what you could do is, you could accommodate their investment, but then you might have to then go ahead and retroactively uprate everybody else to the same terms. So I think it would really just be on a kind of a case-by-case basis, but there's nothing precluding that from happening. The other thing that could happen too is that you're maybe below your minimum minimum offering amount, and you have an institutional investor that is willing to give you all the capital you need on terms you agree to. And really at that point, what you could do is just shut the CF down, return funds back to the smaller investors, and then you could just run a quick Reg D to accommodate the institutional investor. One thing I do want to say too, on these CFs, the minimum investment amounts are actually can be small. I mean, I've seen CFs where $100 is the minimum subscription amount. So you can actually run these CF min subscriptions down fairly low. So if you even wanted to make it where it's $250 is the min subscription and you can participate in the syndication, you can do that. And I think that also drives into the technology that's backstopping these offerings. Most people would think, geez, $250, like, do I really want to have an investor in my deal for $250? But when you see the kind of technology now to manage investors in these deals, it's amazing technology, and it does make it very efficient to manage a large number of investors. So there's nothing to be afraid of if you've got a bunch of people that have come in at $500, for example, because the technology to manage them is there.
Gotcha. Thank you.
I got
Doug,
a
I
question
wanna
from
jump out-
Gregory and then from Kelly. Gregory?
Yeah, Doug, I was just going to ask you real quick. Can you use this model for buying businesses? Like if me and my business partner want to buy an HVAC company and use that to basically syndicate funds from, investors like a real estate deal?
That's a good question. So as long as you're able to structure it where you're not seen as an investment company, yes. So for example, if you have a HVAC business and you're going to go buy a competitor outright, ideally you'd probably buy the assets. You certainly could. You could do a CF, and it could be, hey, we have a HVAC business. We're in the Florida region. We have X amount of revenues, and we're raising this money to expand. And obviously, expansion then could include purchasing, the assets of a competitor, for example. So yes, it can be used for transactions like that.
Great, thank you.
Mm-hmm.
Kelly?
Excuse me. Hi, Doug. Thanks. This is great information. I want to go back to the additional point you just added about the minimum investment amount. That was actually one of my questions. But in addition to the minimum investment amount, can you speak to what you've seen in some of your CF deals that you've put together as far as like average investment amounts? Where my thought process is going is, as Ray had mentioned initially, we typically have a $50,000 or $100,000 minimum investment because we are trying to raise a few $1 million for a particular deal. So as I think about how many investors we would need in order to get to that like amount with a much lower minimum investment, I'm just curious what you've seen from that standpoint.
Yeah, I mean, I think ultimately you could see anywhere from 1,000 up to 10,000. There's nothing precluding an accredited investor from coming in and putting 50 grand in. But I think a lot of these are a lot of the CF sales are going to be somewhere around 1,000 to 10,000. And ultimately, I think, it's interesting you mentioned that, Kelly, because it kind of drives a business model view of this, meaning what we've seen over the last 10 to 15 years is a shift away from the desire to only have a couple investors. This is for serial syndicators, people that want to, raise funds, keep doing syndications, not just guys that want to do a one-off deal and they're done. But ultimately what we're seeing is as you build this affinity base of investors, that's power for future syndications. So as you raise money and let's say you end up with 500 investors in that $3 million deal, well, if they're happy with the experience with Kelly and the team, and you come out with syndication number 2, you already have 400 or 500 people that have invested with you that are happy with you and are waiting probably for new deals to invest into. And so now you may have that 500
Very true.
plus another 500. And what happens then is you build up this investor base, this affinity group of people that have invested with you, had a good experience, and it's syndication power at that point. Because then if you do want to raise 20 or $30 million, and at that point you're probably doing a Reg A plus, you could have thousands of people you're initially going to raise the money. So I think that from a long-term business planning standpoint, we've really seen a shift there, because I deal with guys all the time where, you know, syndicators, or they come in and, you know, hey, last time we did a syndication was 2007. And, you know, the technology wasn't there to manage investors like that back then. And so, you know, they still have that mindset of, well, we just want to keep, you know, we don't want to have a lot of investors, but the game's changed and the technology's there to manage them very effectively. But I think you have to look beyond that. You have to look to your second raise and third raise and fourth raise, or that big multifamily fund where you're going to go do a Reg A and raise 50 million in equity. That's power. All these investors that get to participate with you are there. And they're not just there, Kelly, as investors, they're also there as almost like mini salespeople. Because if I've had a good experience with Kelly and I got, you know, a 12% IRR on a 2-year investment with her, and Kelly's got new deals she's putting out, I'm going to invest, but I'm bringing Ray, I'm bringing Gregory, I'm bringing everybody else with me that I know, because I want them to get that great return too and have that great experience. So that's the other dynamic that we're seeing. So I think a lot of it comes down to, you know, yeah, I still have syndicators that they'll do a Reg D and they just have a couple, you know, high net worth people they're going to cut, you know, $500,000 checks. But more and more we're seeing for people that have that long-term vision of wanting to be in real estate a long time, they're building that affinity group, and that's power for them in syndicating capital in the future.
That's a great perspective. Thank you.
Sure.
Greg, you have another question?
Yeah, this is great stuff, Doug. So I know you mentioned earlier about the fees and everything. Is there a way to roll the fees into the raise, or is that a strict like out-of-pocket cost?
Oh, that's a great question. So actually, let me run you through the fees real quick. I mean, our Reg CF services are $10,000 flat fee. That's all your filing work. That's drafting your circular, assembling all the exhibits, submitting it to the SEC. That's also introducing you to the broker dealer that will be the intermediary. We have a couple options there. And then also Core Connects is our technology partner and transfer agent. They're a $3,500 setup fee. And then, you know, factor in maybe $500 to $1,000 for your escrow. And then if the raise is over $1,070,000, you have to come into it with audited financials. But for most of your real estate stuff, that's going to be a new entity. So you're looking at maybe a couple grand for a CPA audit on an opening balance sheet. So you're right around 15-ish on fees to launch it. To answer your question, you can recoup the syndication costs as long as we line item into the filing and you clear the minimum offering amount if there is a minimum offering amount. So we can certainly line item in that, you know, management or the sponsor, you know, has contributed X to cover syndication costs, and that as long as you clear the minimum offering amount, they are going to recoup that from offering proceeds.
Very cool. Thanks, Doug.
Mm-hmm.
Doug, question on and this is also something that a lot of people ask me about. I have a lot of foreign investors. How can foreign investors invest in this? Is there anything that stops them from doing so?
So that's a good question. I mean, look, a foreign investor can invest through a CF just like they can invest into a Reg D, just like they can invest into a Reg A plus. I think ultimately what you've got to keep in mind is that none of those programs, and not even Reg S, which is the dedicated exemption if you're just doing foreign sales, covers you in those foreign countries. So for example, if I'm a German investor, but you and I are golfing buddies and you call me up and say, hey, Doug, you know, I got this new syndication. Do you want to invest? I go, right, man, that sounds great. Yep. You know, put me in for 25 grand. Even if I'm a German citizen, you're not going to have a problem there. I mean, you know, it was a direct call, you know, to me as an associate of yours. You didn't go to Germany to solicit me. But that's where you could have a problem, is if you went to Germany and you started putting advertising out in Germany saying, come invest in our offering. The German equivalent of the SEC is going to want you to do an offering there in Germany. So I think that's the key to understand there, is just that ultimately these programs can invest foreign investors or it can accommodate them, but it's not going to cover you in a foreign country. So you do have to be careful about going over to that foreign country and doing solicitations over there.
Got it. So if they find me online or somebody I know, then it's fine. But the minute I start, you know, going over there and I start essentially selling securities, what it would seem like to them, then it's a different set of rules.
Correct.
Okay, cool. No, that's good. That's good to know.
So I have a question. What then is the disadvantage of the Reg CF versus the 506B for a small deal or less than 5 million with these changes?
Sure. So 506B can accommodate non-accredited investors. 506B is a traditional private placement, meaning you're not allowed to do any general solicitation or bring in the investors. And that does kind of put people in a gray area sometimes. The best practice advice is that you have a substantive pre-existing relationship with whoever invests into a 506B. The rule now is you're allowed 35 non-accrediteds every 90 days into that offering. But you do have to keep in mind that there are additional disclosure requirements that get triggered with that. So if there is non-accrediteds coming into a 506B, you have to keep in mind that not only can you not generally solicit them, but you are now essentially uprated to the disclosure requirements for a Reg A. And it actually then would mimic the size amount. So if it was 20 million or under, you're really subject to the tier 1 disclosure requirements under Reg A. If it's 20 million or over, you're subject to tier 2. And those are more granular disclosures, certainly, as far as that goes. So I think if it's I think the benefit would be that you don't have broker dealer commissions you're paying, and you would potentially maybe be able to get it prepared a little bit more quickly. So I think those would probably be, if there is an advantage of a 506B over a CF, is that you don't have some of these other vendors involved, so you wouldn't have their fees. But what you also then have to be careful of is just that you've had a firm like ours obviously draft that PPM document to meet that Form 1A disclosure standard, because you are going to then trigger that disclosure standard if you're selling to non-accrediteds under 506B.
Yeah, and I would say, Kevin, the other disadvantage is, I mean, and I alluded to this, you can come in with $2,200, $2,500 on these, on the Reg CF, but to try to do that on a 506B, you're not going to get very far unless you have a lot of accredited investors you can also bring along. So I think that's the key with this. You don't have that. You can bring as many as you want, and nobody has to come in with a large check. Now, if you've got some accredited investors, they can still invest in that Reg CF. And I've seen this, Doug, and I don't know, this is all kind of strategies. I've seen it where if you come in with a certain amount above the minimum, you can give like bonuses to some investors. So you have some investor, they come in, they want to come in with 50 grand, you can give them some extra almost equity for bringing in a sizable amount under that CF. So you can kind of entice some folks to come in with higher. Is that true?
Yeah, so it's basically called bonus shares, and you do see that a lot in CFs. A lot of times what you see that is it's a timing component or a initial raise component. And what I mean by that is, on the timing side, hey, if you invest in the first 2 weeks of our offering launching, we're going to give you some bonus shares in the fund, for example. Okay, so for every 10 shares you purchase, you'll get one bonus share. Okay, so there's that incentive there then to invest early, which obviously gets momentum going in the offering. The other way we see it is just it's tied to an offering amount. Hey, the first 500,000 we raised out of this 2 million, the first 500 is getting bonus shares. So as long as you're in and one of the first investors in under 500,000, you get the bonus shares. So yes, that is a tactic not only in CFs, but we see that in the Reg A plus offerings a lot as well. Kelly?
That was a thumbs up. I like the bonus share to keep the minimum investment up.
You like the bonus share?
I like that strategy.
Yeah, like I said, I think, for me, it's exciting. I've been doing this a long time. I've been doing this since 1999 with this company. And I remember the old days. I remember the old days where you didn't even have 506C. And, we lobbied the SEC all the way through the 2000s for what really came out through the Jobs Act. But in the old days, you just had the traditional Reg D private placement programs. You didn't have the capability to do any general solicitation. There was no Reg CF. Reg A was the old Reg A, which was extremely cumbersome to use. And And so it's just amazing in the last 10 years to see the changes. And then, like I said, you pair that up with the ability to get massive exposure via social media and again, build that affinity base long-term. So you have this backstop of investors that are always looking to participate with you. And now add in the technology to get them through the investment process in 3 minutes without having to upload CPA letters and all that other stuff that you got to do with the 506Cs because they have to verify they're accredited. And then having technology to manage those kinds of investors on the back end very efficiently. It's just an exciting time. And I think the changes that the SEC has made are impactful. But you know what? It's there to help drive growth. You're all entrepreneurs. You're all out raising money. You're all trying to, build businesses and buy assets and improve neighborhoods. I mean, I think that's the other thing. You can look at the social impact of doing this where, I have a real estate operator clients where, they're raising money and they're deploying it into, some pretty downtrodden areas and looking to rehabilitate areas. So it really is an exciting time. And part of it is just education, which again, Reyes, why I'm, very appreciative of being on here, because a lot of people think, for example, that the Reg CFs are still old school crowdfunding, limited to $1 million. We have to be up on one of these platforms. And they don't know that actually, no, it's completely changed now. And you can essentially execute it on your own Raise portal up to 5 million. And you essentially get a public offering with it without having to go public.
Doug, just curious, have you had any folks that have done a development project where, they start off and, there's a land acquisition component and then it kind of goes into an actual vertical construction? Or I'm just curious if you've seen anything like that and how you would structure that.
We have, and a lot of it depends on whether the developer has the property under control or not. Obviously, if they don't, then you're building into the raise amount, getting the property purchased, getting it developed and titled on a horizontal basis, and then obviously going vertical with whatever the assets are. In some of those deals, actually, we'll see it where it's phased. So they might do, hey, phase one, we're acquiring the property, we're getting it permitted and titled, and we're going to do some, some development work. And then, phase two, they might raise some more money to then, go vertical with spec homes or whatever the asset may be. So yes, it can be used for development projects. But like I said, sometimes it'll phase because it might be a 3-year project with multiple phases. And then, you just can execute different rounds of funding. Those are also deals where we're typically going to see it being equity raised because they're usually going to have a construction lender that's providing the bulk of the funding, at least for the vertical construction on the assets. And then I think, just some good advice on coming into this process. People always ask us, hey, like, what are you going to need, to put this in place, and what does that look like? A big piece of what we need, if we're just going to, let's just say as an example, it's a single asset acquisition. And let's say it is a specific asset. We're obviously going to need information on the entity raising money. That's probably going to be an LLC. It might be a limited partnership. We also do real estate deals where it's an LPGP structure. So we're going to need obviously articles of formation. We'll need your final operating agreement. We're going to need obviously information about the asset itself. We'll need the sales contract. We need information about the management team. And then obviously information about what's being done with the asset. Is it being rehabilitated? Is there construction work happening? What's the investment methodology and what's the strategy for the asset long-term? We'll then obviously build in some of the balance of exhibits. There'll be if you're raising over $1,070,000, it's a CF, there'll be an audited balance sheet in there along with subscription docs. But that essentially is going to build out that filing. And then the Raise portal gets built alongside that at our firm. So obviously we're building the Raise portal, and then we're coordinating with the broker dealer and transfer agent to get everything ready to go, so that ultimately when you're ready to go raise capital, that portal's built. We got everything integrated with our technology partner, and then that gets launched onto the broker dealer's hosting, and it's then theirs to essentially manage through the term of the offering as your Raise portal. Again, I would typically recommend factor in 45 to 60 days to get that done. There is obviously a lot of coordination happening. You obviously have the broker dealer getting escrow accounts in place, and they're also getting payment rails in place. So, there's merchant accounts for these deals that are being put in place. So there is some work to do. as far as putting the CFs in place, but ultimately it's all there to then give you that vehicle where, again, you can raise money from everyone, 3-minute investment process, and then those additional vendors really do bring some confidence to the equation. You have a thinner broker dealer, on board with your offering, and you have a transfer agent, SEC approved transfer agent recording the securities. So if it's something like a real estate fund, not much is going to change beyond obviously the info that we're getting in. Now it's not a specific asset. Now we're getting in information on what is the asset class? What are the markets you're operating in? Are you using leverage? If so, what are the limits on that leverage? What's the investment management strategy for the assets? So now it's more framing up what are the assets we're going to be acquiring, how do we source and vet those assets, what's the capital stack look like for purchasing them, and then what's the investment management strategy going to be. And then obviously with the real estate funds, you're raising the money first, then you're going and putting the assets under contract. So you do have that ability then, once you clear your minimum offering amount, to be opportunistic at going after assets that then meet your criteria.
Doug, I know you've shown me this, but I don't know if there's if you can mention where folks can look at a portal. And I gotta tell you, I mean, they are top-notch portals. This isn't, some back of the envelope looking thing. They are super professional. Where can they see that?
Yeah. What I usually recommend is that I can actually set up, because there's really two pieces to our CF portals. There's essentially the engagement page website and WordPress website we're building to run the Reyes, but then the processing and the investors, we're using Core Connect's technology on that. So what I'll do there is if people want to reach out to me, I can not only set up a demo where they can see the kind of Reyes portals that we build, but then they can also demo Core's technology. And I always recommend that. The folks at Core Connects are fantastic. They will set up and do a demo for you and show you that technology. And really, I almost make it a requirement before someone comes in and retains us for a CF that they do that, because I want them to see that. I want them to see how efficient that process is with Core Connects using their technology. But it's not just the subscription process. It's not just the 3 minutes and I'm done, I'm moving on with my day and I've invested with Ray. It is the back end system that manages these investors. So what I suggest is just, you can reach out to me if you're interested, and what I'll do is I can set you up with a demo with them, and they can actually show you what those model sites look like, but they can show you their back end, because those CFs are running their back end for the investment process, because you've got the payment rails in. Most of what you're seeing on the CFs, about 80 to 85% is credit cards. So people are they're going to put 3, 4, 5 grand on their Amex or their Visa. They can also do wire ACH through there. And then there's also the ability to do crypto to fiat, which is kind of cool. If I want to invest in your syndication, I want to use some Bitcoin for it, I can do that. So I would say reach out. Happy to set you up with those folks, because they're a key partner of ours, and they really have the best technology, in my opinion, for backstopping that piece of the Reyes.
I'm going to post your contact information on the YouTube channel when I pass this recording. But if you don't mind, Doug, go ahead and put your or give your email, or whatever way you want folks to get a hold of you. I suspect you're going to have quite a few.
Yeah, absolutely. So you can, first of all, our corporate website is regdresources.com, and that is regdresources.com. And then I'm going to give you my direct line. So anyone on this podcast, if you want to reach me directly, I'm more than happy to chat with you about these programs. Also happy to see what's a good fit for you. You may be a syndicator that's maybe has a raise amount that's going to exceed 5 million, and maybe you want to look at doing a Reg A plus. And we haven't really talked about Reg A much, but that is a kind of a next tier program that would allow you to raise up to 75 million using a pretty similar process. It is a little more sophisticated to put one of those in place. My direct line, 720-586-8616. More than happy to chat with anyone. And my email is Doug, D-O-U-G, at regdresources.com. And again, on demo stuff, more than happy if you want to reach out, I can connect you with the folks at Core Connects, and they can run a demo for you on the CF backend software that we use for the subscription processing.
Fantastic. With that, I'm going to let everyone go, and remember, invest where it makes sense.
Thank you.